Hi everybody, welcome to the Leeb.com video for September 20th, 2011. Be sure to visit Leeb.com, Leeb.com to sign up for our free daily emails. Well, this week, all eyes are on the Federal Open Market Committee meeting to conclude tomorrow to see what the Federal Reserve's latest monetary policy decision is going to be. It's expected that the Fed could decide to sell short-term treasuries and buy long-term ones in order to push long-term yields down further. The problem, though, is that right now, long-term yields are already very, very low. The extra income that, or the spread that an investor can earn for holding a 30-year note compared to what he could earn by holding a 5-year or 10-year note has become laughably small in recent years, resulting in a flat curve. A curve this flat essentially means that bond traders don't expect much economic growth ahead and thus do not fear inflation. However, this time around, there seems to be more at work than just that. With weak economies in the developed world, twin debt crises here in the US and in Europe, and a big budget showdown looming in Washington, current yields reflect a flight to quality and very easy monetary policy enacted by the Fed. These things have moved the entire curve downward towards zero. This basically means that the bond market is scared to death and will accept extremely low rates or low spreads too in return for anything close to safe havens. It's the same reason why investors are tolerating negative real returns when you adjust for inflation on 2-year and 10-year treasuries. Until short-term yields on 2-year notes, for example, start to rise, the bond market will not be signaling a return to growth. If long-term yields turn around and begin to rise without a pickup in growth, that will mean that inflation is returning as a concern. On the other hand, though, in the best case scenario, if long-term yields fall but growth picks up, the Fed will have basically threaded the needle and kickstarted a recovery. And hopefully that's what happens. That's it for today. Thank you for watching and join us again soon.